for taking the time to be here with me live as we cover a very important topic, which is the opportunity cost of not investing in real estate. I'm just going to give it a couple more minutes for people to kind of filter into the room. But if somebody will actually go to the Q&A box and just make sure that you can see my screen, that would be amazing before we got started. Just go over to the Q&A box and say, I see your screen. That'd be cool. All right. Well, I got 101. Let's get started. All right. Welcome. Today's live show. This is the Passive Investing Made Simple Masterclass. My name is Whitney Elkins-Hutten. I'm the Director of Investor Education here at PassiveInvesting.com. And I do this weekly webinar series to help you get familiar with all the ins and outs of passive real estate so you can go confidently into your first or next deal. And normally, a lot of times I have a guest on. Today, it's just going to be you and I chatting about the opportunity and cost of not investing in real estate. And I thought that was just a really important topic to talk about because, you know, in today's economy, we're hearing all sorts of information about inflation, recession. Maybe I'm just safer having my cash sitting on the sidelines. And I want to actually kind of pick apart these topics a little bit and help you kind of decide with math what is the best course for you. But if you don't, you know, essentially what we're going to cover today is what opportunity cost is, why it's important that you understand what this concept truly is, how it operates, and then actually how to calculate it. We're going to learn the 4 different principles and 3 rules that all investors should be abiding by here in order to reduce opportunity costs. And then we're going to actually look at different assets in today's market, real estate, non-real estate, and actually calculate the true opportunity cost if you're in one of these particular assets. All right. Now, if you guys don't know me, this is me and my crazy crew. This is why I invest passively in real estate. My husband and I got started off in active investing in 2002, living, flipping, and house hacking totally by accident. Fell in love with the concept, realized I could make buckets of equity, but I couldn't unlock those golden handcuffs. I didn't know how to actually get myself out of that paycheck dependence. Fast forward a few years, my husband and I built up a rental real estate portfolio and then transitioned into active multifamily investing, and then realized when our daughter came along that we really wanted to be far more active, at least at this point in our accumulation build, far more passive rather than active. And so that's when we transitioned in passive investing. And, you know, through passive investing, as well as our active acquisitions, we've scaled up to over 6,300 residential units, 1,400 self-storage units. Actually, the self-storage units are a little behind as of August. And also car washes and hotels. We run the gambit. But what you see there is the tip of the iceberg. There's a lot of work that went into building up this type of portfolio. But what I'm sure you are here for is to figure out, like, how can I use passive investing to scale a portfolio that gives you a result? And that result is that you have 100% control of how you spend your time, control and choice. I love talking about the 5 freedoms that real estate can give you, which is financial freedom, which most people are really seeking. But it's not just that. There's financial freedom, freedom of time, freedom of location, freedom of choice, and freedom how you want to create an impact in the world. And that's why I love talking about real estate, because that right there, you don't have to have a special degree or anything like that to get involved. Now, as I already kind of previewed, today's topic, we're going to talk about opportunity costs. We will talk about different terminologies. We'll talk about some finances, but when I do this educational series, it's not financial advice, tax advice, legal advice. So make sure you're taking this information back to your team and modeling it and make sure it's working for you as you make investment decisions. All right. Now, I know many of you, like me, are watching the headlines, and this is over the course of the past few months. Really, if you're watching the headlines, inflation's at 40-year highs, get ready for the recession. The recession, all the warning signs have lined up this week. What is America going to look like after a recession? How long will it be? When will we know? You know, the media is really painting this, that there's a lot of blood in the streets. And there may be, okay? I'm not going to sugarcoat this for you. Inflation is high. It's probably higher than what the government is disclosing. You know, GDP is down. It's probably lower than what the government is disclosing. Now, but when you look back at all the wealthy, and we're talking the wealthy barons, the Rothschilds, the Vanderbilts, the Carnegies, like when they were building their portfolio, when they were scaling their businesses, they learned how to invest through these rough times. And so there's a quote by Baron Rothschild that is, buy when there's blood in the streets. Many of you guys are very probably familiar with that. The second part of this quote that very rarely ever gets published is, even when the blood is your own, okay? And I'm going to show you today, as we did, kind of pick apart the opportunity cost, what these 7 principles are that I use in my own personal investing, that when you read across like the Ray Dalios, the Warren Buffetts, they're all including these 7 core principles in their investing too. I want you to take note of what these are and make sure that not only you're evaluating your current portfolio, what you're holding, but also helping you make future decisions. All right, so what is opportunity cost? Let's just define it really fast. Okay, now I took this from Wikipedia. The opportunity cost is the value or benefit given up by engaging in one activity over another. Okay, more simply, it means if you choose one activity, you're giving up on the opportunity cost of the different option, okay? Now we wanna be on the winning side of opportunity cost, not on the losing side of opportunity cost. So while we might be able to kind of go, well, yeah, I see 2 investments and they might be operating entirely differently and I could make more money over here, what does that actually pencil out to in the math side? So let's actually take an example. So here's our formula on the right-hand side of the screen. And let's say investment number 1 offers a 10% return. And investment number 2, the one you're currently in, offers a 2% return. Let's just pretend like, this is a year ago and you had your cash sitting in the bank and you were still making 2%, or a year and a half ago, or 2 years ago. Your opportunity cost, you were losing 8% because one was making 10% and the other one's making 2%. Now, you need to actually be able to translate this into dollars, okay? So what you would do is then multiply the opportunity cost percentage with the total money that you initially invested. So if you have $100,000 sitting in the bank making 2%, which by the way, if you are, that's very strong numbers in this environment, versus investing it and making it at 8%, you're actually losing $8,000 a year. That's your opportunity cost. Now, a lot of math, simple math, stops right there. But it's actually worse than that, because you need to take that $8,000 loss and compound it out over time, because you could have had $8,000 year over year, and then you need to compound that out, that loss, over time. So let's just say you take $8,000 then, and you could have invested it at a 10% preferred return or a 10% return for 30 years. Now you've actually lost, just in that 1 year, that $8,000 loss actually equates to a $139,000 loss. You guys can check my math. There's a great calculator at investor.gov, compound interest calculator. There's tons of them all over the internet. I just like that one because it's very transparent. It's really easy to work. But the true opportunity cost isn't even just the simple math that we see here on the screen. It's actually what happens with that loss that's compounded out over time. So we're gonna walk through some principles here, and then I'm gonna come back to this, and we're gonna kind of put a little pretty bow on it, comparing different asset classes and what the true opportunity cost is in today's environment if you're investing one asset class over another. All right, so what are these principles? Now, I call these the 4 tenets of conservative investing and the 3 rules that an investor needs to abide by. Now, you can wrap them all together as the 7 principles. The 4 pillars of the 4 tenants are capital preservation, cash flow, equity growth, and tax benefits. And our 3 rules is that we need to make sure that the investment has some sort of inflation hedge to it and it's smart use of leverage. Now I'm going to save the 7th rule for you guys because I don't want you just taking a screenshot of this and then, checking out on me. I'm going to save the 7th one until the end, which is by far probably the most important rule that an investor, especially a passive investor, needs to be abiding by in today's environment. All right, so let's quickly motor through these, okay? Because I want to make sure I leave plenty of room at the end for, Q&A and conversation. So pillar number 1, capital preservation. This is our buddy here, Warren Buffett. His number 1 rule of investing is don't lose money. Rule number 2, rule number 1, quite simply is we don't want to lose principal, okay? We already proved when we did our math on opportunity cost, how disastrous that can be for your wealth building. All right, so how do we do this? What are some basic fundamentals here? You want to make sure you're investing in assets that are secured by a hard asset. They actually are valued based on their net operating income or expected gross income, okay? And the reason why I'll show you this here in a couple slides is we actually want some levers that the business can pull to actually increase the value on the asset. We don't want to just rely on what the market's going to give us for our valuation. We don't want to spin the wheel and kind of hope and cross our fingers. We also want to make sure that whatever asset that we're investing in, be it in a passive deal or actively holding ourselves, that we're maintaining enough reserves for this asset, both from operational reserves, day-to-day operational reserves, and CapEx reserves. And again, this is either you holding your own assets, or when you invest passively, you want to make sure that the operator is holding these reserves. Now, I'm going to couch this, and like I said, I was going to show you different asset classes, but let's go ahead and kind of like pin these against each other. Who are the winners and losers when it comes to capital preservation? Well, right now, the losers in today's environment are cash, Bitcoin, and to a certain extent, paper assets. Now, I got to put a little asterisk next to paper assets. Unless you sell your shares, you have not lost your capital. However, most investors aren't willing or able to have the mental fortitude to take a 50, 60, 70% loss and watch it go all the way down and then wait it out for their capital to come back. Now, in today's environment, the winners are multifamily, self-storage, car washes, hotels, and also real estate notes, okay? I'm always talking about secured notes. I'm never talking about unsecured notes, but I'm talking about secured notes backed by real estate. And I'm going to show you why real estate, how it adheres to these principles here in a minute. Second pillar, we want to make sure the asset has some sort of cash flow in today's environment. Now, a good friend of mine, Ryan Lee at Cash Flow Tactics, told this wonderful story. He says, you can have an apple tree and once it's matured, it will produce apples year over year over year over year over year. Whereas if you just plant one pine tree, you have to cut it down in order to sell the wood, and then you have to plant a new one. So he likes, he was equating this residential real estate, commercial real estate, and as having a lot of apple trees to where you can have multiple units of cash flow that ideally start from day one. Okay. Like capital preservation, we also want to make sure that there's several levers that you can pull to increase value on the asset. And I'm going to talk about that. And when we talk about equity growth, we also want to make sure that the expenses to run the asset are pretty low. This doesn't matter. This is all applicable whether we're talking about multifamily, whether we're talking about self-storage, car washes, hotels. We want our expense ratio to be as low as possible and our income ratio as high as possible. So we've got a nice, healthy margin there that buffers our cash flow. And again, we also want to make sure we have those reserves on hand, especially operational reserves that will help us maintain the asset if we're in some sort of seasonality with the asset, or if there's a disruption to the business plan. Now, when we look at our core assets that most people are investing in today, losers are cash, gold, and Bitcoin. They don't cash flow. There's no way to make those cash flow. Unless you're running some sort of fund and leveraging it out. The winners are multifamily, self-storage, car washes, hotels, and notes, secured notes backed by real estate. Now, I put in another category here because there were some wannabe winners. Like some paper assets actually do cash flow a little bit, like 1, maybe 2, maybe 3%. So there, some assets do have a little bit of cash flow with them, but again, it's not something that you can entirely control. Now, our fourth pillar is our equity growth and plus our levers. And here, what we're talking about is there's 3 ways to increase the value of an asset. Number 1, market appreciation. We can purposely buy assets in growth markets where there's a path of progress and that there's room to grow the rents. Okay, now we could buy the top asset in an area and on the right side of town, and the market appreciation could work for us. But we're giving up a lot if we don't have some sort of forced appreciation plan. Forced appreciation plan really puts us in control as an investor, or the operator in control as if you're investing passively. And that is where you want to see a plan where there's a way to increase the income in the assets, decrease expenses, and add additional streams of income to the asset. Okay. Why do we want that? Because when we start increasing the value of an asset through forced appreciation, the market can actually get worse on us, okay, over time. But because we're increasing the value, we're still, increasing the income on the asset, either through NOI or expected gross income, we actually are still increasing the value on the asset in a downward market. Okay, that's why I really, really love projects that have some sort of element of forced appreciation to them. And then we got number 3, we outsource the debt. Okay, so we'll talk more about leverage here in a second. But this is why, using debt on a property and having either the customers or the tenants pay down the debt for you can be such a powerful equity building strategy. Now, in today's environment, our losers are cash, gold, and notes, actually, because notes, they just cash flow, they preserve capital, they're secured note, but they don't produce any sort of equity for us. Our winners are multifamily, self-storage, car wash, and hotels. Our wannabe winners are Bitcoin and some paper assets. Now, Bitcoin right now, I'm going to show you, is down massively. If you bought Bitcoin in the past 2 years, you're probably losing your equity right now. But again, like paper assets, you haven't lost that equity unless you sell your shares. So you can again continue to hold on to that, in perpetuity until your equity position came back. Most people, from a money psychology standpoint, can't see their asset going down 20, 30, 50% and be okay with that. Okay, there's a big amount of psychology there. Now, our fourth pillar is tax benefits. We want to look for assets that offer depreciation, accelerated depreciation through cost segregation analyses, bonus depreciation. Okay, this is the last year for 100% bonus depreciation. It'll start ticking down over subsequent years unless new legislation comes into play. And also affords this 1031 exchange, so we can continue to defer depreciation and capital gains tax into future years. And if you're like a lot of investors that really love and embody real estate, you're investing it for a multi-generational wealth strategy. So you're going to die with the asset in your possession and then pass it on to your heirs, and hope that tax, those taxes go away, with today's laws. So that's amazing. That's a very powerful wealth building strategy. Now, who are losers? Okay, right now our assets that are losers are cash, gold, Bitcoin, and notes. There are no tax benefits to holding these assets. Okay, and our winners are multifamily, self-storage, car washes, hotels. There are some paper assets like municipal bonds, real estate investment type trust. They might be able to pass through some tax benefits to the owner or whoever's holding that asset. So there are a couple. I couldn't quite just totally rail on paper assets and put them in the loser category, but there's a couple options in there where tax benefits can pass through. There's also with paper assets, you can sell your assets at a loss and harvest the loss. Now, this is a higher level strategy. Make sure to partner with your tax strategist on this. And again, but it does mean that you lost equity, but you can get a tax benefit if you lost your equity. So kind of a double-edged sword there. All right, now we're moving beyond our 4 pillars. Now we're getting into kind of our 3 rules, and I'm going to cover 2 of them right here. We want to make sure we're investing in assets that have some sort of, especially in today's environment, have some sort of inflation hedge to them, where we have the ability to pass through expenses and increases to the end customer. We want, be it fixed expenses like, tax increases, insurance increases, our variable expenses, which are like our vendor contracts and stuff like that. We also want the ability to raise the income on the asset. So we want to be able to move that through. Now, I like assets to where you have, you can at least readjust all your inflation, your cost of the asset, your income on the asset on a minimally an annual basis. There's some, other assets out there, and we'll touch on it here in a minute, that you can adjust on a monthly basis, a weekly basis, even a daily basis. Okay, so that there begs the question, how often can you adjust your income? Now, when we look at, across the assets we're evaluating right now, our losers, cash, notes, because once we lock in a note, we generally cannot, unless it's a variable rate note, which generally are not, are in a second position. They don't have a first position lien. Our notes generally, we can only set the rate at the beginning and we can't adjust it afterwards. Bitcoin, okay, there's no inflation hedge there, and also gold. Winners are multifamily. We can adjust the rents annually. Self-storage, we can adjust them monthly. Car washes, we can adjust them weekly, and hotels, we can adjust them daily. And so wannabe winners are paper assets. And this is, like your, especially whenever, the S&P 500 is investment in business, we hope that the business is actually, taking advantage of inflation, adjusting their income and adjusting their cost, thereby, increasing their own net operating income, which puts investor share pricing in a better position, but it's not a direct correlation. All right, one last rule we're going to cover right here. This is a lot of information, but definitely, you guys are going to get the recording, link to this recording, so you can go back and watch it again. But that's leverage, okay? Especially in today's environment right now, we want to be able to use debt wisely and safely arbitrage the interest rate environment. And I've got a few kind of like guidelines for this. Okay, they're not hard and fast rules, though I try to line up as many of these things as I can on any investment that I'm going into. I like to see, the asset not being over leveraged. I want 75% or less. If I can get it, get it lower, fantastic. I would love to see fixed rate debt on the loans. That's ideal. If it's floating rate debt, I want to make sure it's capped, that there is a cap that is purchased, and that it's not, that the underwriting is underwritten at the capped rate. I'd like to see fixed term. Okay, so 7-year debt, 10-year debt, whatever that debt length is, 30-year debt. Or I want to see if it's floating, maybe it floats for 3 years, and then I want to be able to see extensions being purchased and locked in now, that contract's been negotiated right now. So there's not going to be any surprises during the business plan. Also, I want to see the debt for at least the term of the business plan, if not longer. So the business plan is to start repositioning the asset after year 3. I want to see debt for 5 years or 6 years on the asset. I want to see, give some breathing room to be able to reposition that type of asset. And I also want to see debt that has low or no prepayment penalties. Government sponsored debt like Fannie Mae, Freddie Mac loans are amazing for multifamily products, and unless negotiated out, they can come with some pretty steep prepayment penalties, which might actually keep the operator from selling at the height of the market. So who's winning, who's losing? Cash, gold, Bitcoin, paper assets, and notes. They don't have any way of taking advantage of leverage. Now there are funds out there that you can invest in, but guess who's the leverage? You are. Okay. Winners, multifamily, self-storage, car washes, and hotels, because you can actually be on the equity side of the deal and take advantage of the leverage. Here's some just kind of quick snapshots on where we're at. I'm going to kind of sum this up a little bit. Cash, it's losing on all 7 principles. Gold doesn't create any cash flow or tax benefits. You can't force the equity on that either. Cryptocurrency, there's no cash flow, no tax benefits, and capital preservation is pretty questionable right now. Paper assets, lower no cash flow, lower no tax benefits, and capital preservation is not guaranteed. Now, what about real estate? I'm going to, again, just go through these slides pretty quickly. Multifamily is winning on capital preservation, cash flow. It's winning on equity growth. It's winning on tax benefits. It's an inflation hedge because we can adjust on an annual basis, and we're still seeing some pretty good interest rates on these type of debt. So our last deal was a 4% loan. We're probably like closer to 4.5, 4.75 at this point in time. Self-storage, good capital preservation, good cash flow. You can, pull all those 3 and net operating income levers. There's still a great opportunity for market consolidation. This is still a pretty young asset class. We get great tax benefits with it. Our inflation hedge is we can actually move the income on a monthly basis, and we're still seeing really good interest rates and fixed interest rates in this environment. Express tunnel car washes. Again, this is investing in a business that holds real estate. We have good capital preservation, especially if you own the land. You got to own the land underneath the car wash. And I'm not talking about just any type of car wash. It has to be like an express tunnel car wash, one that you can generate high expected gross income on. We're still getting good tax benefits, and it's a good inflation hedge. With the subscription model, there's a good margin there. I mean, just with the expenses to run a car through a car wash, water, electricity, and the chemicals, we're not talking about labor here. It's about 80% cents per wash. Our subscribers are on average doing 2 washes a month. The average subscription is about $25, $25 to $30. So there's a pretty healthy margin in there. And we still see really great interest rates. In hotels, again, they give, I'm going to refer you back to a presentation that I did a few months ago on hotels to kind of pick apart this asset class and what specific type hotels we're investing in. But in the limited service space that's leisure driven, we're seeing great capital preservation, great cash flow, an amazing opportunity for equity growth as corporate travel comes back. We have similar type of benefits through depreciation, 1031 exchange, and inflation hedging. We can actually adjust rents daily and even during the day if we need to. Now, as promised, I was going to give you the math. Okay. But first, let's kind of put this all together. This is what I love showing people is, as we lay out these 4 principles, and the 2 rules or accelerators, you see these assets really don't fill in the gaps very well. Okay. And year-to-date performance, they're coming down. Cash is losing 8.5%, gold 2.5 or 2.4%, cryptocurrency is down 54%, and paper assets has been down anywhere between 12 to 23%. And as we start filling in these pillars, the 4 pillars in the inflation hedge, now we see that because we have multiple ways of making money and hedging the environment, we're seeing stronger returns in these asset classes. Now, this is fantastic and all, but this isn't the math. So if we actually take that formula at the very beginning, opportunity cost, which is what you're currently holding versus what you could be investing in, okay, what you're investing in minus what you're currently holding, that there is the opportunity cost. We can see here, okay, if we take our year-to-date performance, cash versus notes, secured notes, especially if your secured note is yielding 6% like our PIK debt fund is, your opportunity cost, you're losing 14.5% on your money. Okay, that's 14, if you invested $100,000, that's a little, $14,500. Now compound that out over 30 years. That's the true opportunity cost here. You can see cash versus self-storage, multifamily, car washes, and hotels. So take a screenshot of this. Like I said, all I did was follow the math of opportunity costs and dropped everything in, in there, and this is what it yielded. Cryptocurrency, again, it's amazing when the price is running up, but right now it's not. This year alone, cryptocurrency versus notes, you've taken almost 61% opportunity cost there. So math is kind of hard. It's kind of hard to refute the math, I guess is what I'm trying to say. All right, so the takeaway here, when you don't invest, or you invest in assets that don't adhere to multiple wealth building principles, you might find yourself losing wealth, at most, if you're lucky, breaking even, or you're having to take outsized risk in order to achieve a return. Now, real estate allows you to make asymmetrical returns by getting paid multiple ways and helping you mitigate risk. All right, guys, that was a lot of information. I want to make sure I, wrap up with the very final principle here, because we only went through 4 pillars and 2 rules. The last rule is, if you're going to invest passively, you have to invest with experts. You have to invest with people that have a proven knowledge of the space, that have a proven expertise and track record to perform. Okay, they have to have the ability to secure credit and lending for high quality assets. All right, and they have to have if they're going to do syndications, they have to be able to reliably pull together capital to close and manage the asset. All right, and they have to have a professional team and network to help them run the deal. Okay, this isn't the time to work with operators that are like a 1 or 2 or 3-man show. You want to look for operators that are a part of a team and a network to operate these assets on your behalf as a passive investor. All right, guys, I know there's tons of questions coming in. If you're here joining with me live, we're going to answer those in our after party session. If you're listening to me on your favorite podcast player of choice, thanks so much for joining in today. Make sure you reach out at passiveinvestingwithwhitney.com. There you can take a look at our open deals. You can also schedule time with me. I also have some amazing goodies for you when you register on that website. And here's my contact information for you as well. All right, guys, don't go anywhere.